Thank you for joining us and welcome to our third webinar in our series on capitalizing on opportunities available now. This episode should last about 15 minutes and I will be moderating with William Ellis as our presenter. Please type any questions you have in the chat box during the session and we'll address them in the time allotted at the end. The webinar is being recorded and we'll send you a link afterwards so you can view anything you missed or to pass along to someone who might benefit from listening. As always, we will post it on our website where you can view it anytime. You can also view our previous webinar episodes on our website in our content library. Our webinar today has 4 sections. The first is a look at current tax rates in Canada. The second section takes a look at the impact of taxes. The third section examines how a rise in taxes may affect your portfolio. And finally, in the fourth section, William suggests how we can anticipate and prepare for the future and a possible rise in taxes. William, can you take us through this slide and the current tax rates in Canada?
Sure, Matt. On this slide, we illustrate personal income tax payable at various income levels for different types of income.
Well, I think what really jumps out are the rather modest taxes payable on dividends and capital gains.
Yes, that's for sure. Dividends and capital gains are lightly taxed, whereas interest income is heavily taxed. The first $40,000 of dividends or the first $40,000 of capital gains earned, an investor is essentially given a pass on taxes. In contrast, interest income, like employment income, is punished with higher taxes. The difference is significant. If we look at this chart a little bit further and think of a couple who are retired, who would like to have cash flow to spend of about $10,000 a month or $120,000 a year. If they were to organize their finances properly and invest appropriately, they could earn $80,000 in dividends, $40,000 each, supplemented by $10,000 each of capital gains, and further supplemented by $20,000 withdrawal of capital. So if we add those figures up, $80,000 of dividends, $20,000 of capital gains, and $20,000 of withdrawal of capital, totaling $120,000. From this chart, you get the idea that they would pay next to nothing in taxes.
And you may recognize this slide from our last webinar, but this time we've highlighted taxes as being outside of our control. Can you add to this, William?
Sure. Taxes are one of those things we have no control over. Just like interest rates, inflation, and the economy. We don't make the rules. CRA and provincial governments set the tax rates and tax laws without consulting us. And now, in contrast to the 1990s, when tax rates in Canada and around the world were being reduced, the trend in Canada at the federal level and also at the provincial level is for income taxes to increase, mirroring what is happening in country after country around the world.
And so what is this chart showing us, William?
Well, we wanted to illustrate the impact of taxes on our capital over time. And we wanted to compare that to a no-tax world. So on the right, you'll see a scenario with no tax. And as we move to the left, we see the impact taxes have on our capital depending on the source of the income, because each type of income is taxed at a different rate. So assuming we start with $100,000 of capital and earn 6% a year over the next 20 years, as indicated on the far right of this chart, at the end of that period you'd have $320,000 of capital.
But we do have taxes.
Right. And our capital is eroded by the taxes we pay. As we move from the right to the left, you see the impact on capital of the tax paid. Now, deferred capital gains are the most efficient way to compound your capital because you benefit from two things. First of all, from lower tax rates on capital gains, and you benefit from deferring the payment of tax until it's realized, the capital gain, allowing for more of your capital to continue to grow and compound. Then over to the left, another notch. Dividend income is taxed at slightly higher rates and doesn't benefit from tax deferral. And we see the erosion of capital is meaningful when magnified over a 20-year period. Interest income offers no deferral and attracts the highest rate of tax. The impact is very clear. Meaningfully less capital accumulated over 20 years versus dividends, capital gains, and certainly less capital versus a no-tax world.
And there's a lot presented here in this slide, so you can clarify what we were showing here?
Sure, it's a complicated slide, but you know, the last slide focused on the impact taxes have on investors accumulating capital over a 20-year period. This slide takes the point of view of an investor who has already accumulated his capital, who's retired or close to retirement, who wants to live off the capital they have accumulated. It illustrates how long capital will last for two different portfolios. The first, a bond portfolio earning 4% a year, and the second, a balanced portfolio earning 6% a year. The chart on the top left illustrates that $1 million earning 4% interest, which is taxed at 40%, will last 21 years if you withdraw $60,000 a year from your portfolio for your lifestyle and luxury expenses. On the bottom left, a balanced portfolio earning 6% a year is taxed more lightly at 20% tax, and it will last therefore 34 years or 13 years longer than the bond portfolio before the investor runs out of money.
And what are the two charts on the right illustrating?
Well, the title of our webinar is, What if Tax Rates Rise? And the two charts on the right-hand side illustrate the impact of a 50% increase in the tax rate that is used to tax each portfolio. The impact is as you would expect. With taxes eating up a larger share of the income that is earned, the capital is depleted sooner. In the case of the bond portfolio, the capital lasts 19 years versus 21. And in the case of the balanced portfolio, the capital lasts 29 years instead of 34. So
after examining the last slide, what kind of effect would a rise in taxes have on the portfolios of individuals preparing for retirement?
Well, the effect is significant. Higher taxes threaten to slow down the accumulation of wealth prior to retirement. Higher taxes threaten to divert cash away from spending on our lifestyle and luxuries expenses when we are in retirement. And it increases a risk of running out of money in retirement. It increases the need, really, to organize our finances and investments, taking taxes into account.
So, William, how do we work with clients to anticipate and prepare for a rise in taxes?
Well, we work to move taxes from being something outside of our control to something that we anticipate and prepare for. And in this regard, we focus on three things: tax-efficient investing, tax-smart insurance strategies, and estate planning.
And finally, our favorite slide, but this time with a focus on tax efficiency. William, how does this relate to today's webinar?
As we've highlighted many times before, estimated market yields are attractive for dividend portfolios and growth portfolios. The stark contrast today, though, the stark reality is that we don't live in a world of 6% GICs or even 4% GICs. As indicated here, the estimated market yields of cash and government bonds are 1 to 2%. Focusing on tax efficiency regarding this slide, the dividend and capital gains expected from the dividend and growth portfolios are lightly taxed and offer some deferral of tax, both very important whether you're accumulating capital in preparation for your retirement or looking for your capital to sustain you through your entire retirement.
Thanks, William. And a question I have here in the chat is, what are the risks of investing in stocks for dividends and capital gains?
That's a good question. You don't get something for nothing. With CDIC insured GICs, you know your principal will be returned to you at the end of the term. With stocks, you don't know what they will be worth at any point in time. The dividends aren't guaranteed, capital gains are not guaranteed, and your principal isn't guaranteed either. And that's why I suppose that we're able to buy our dividend portfolio and our growth portfolio these days with an estimated market yields of 8 to 10%, because many people want guarantees and they're prepared to accept very little return in exchange for a guarantee.
Thanks, William. And that's it for questions. So thank you for joining us today. And if you would like to discuss today's webinar further, please feel free to contact us at 416-969-3190. Thank you, and I will now end today's session.